traders, welcome to a new trading theory video of mine. In today's video, I want to look into the zero-sum nature of the cryptocurrency markets. I've never really gone into depth about one person's loss is another person's gain and other kinds of negative sum / zero-sum theory. But in today's video, I want to look into exactly that, and we're going to look at open interest, liquidity, competitors in the market, and also, as the final part of this video, to look at how we can be on the winning side of the transaction more often than not. So if you haven't heard yet, I currently also have a discount on my price action volume guide. And if you're interested in learning more about price action and volume and how to exploit other traders in the market, you can click the link in the description below. And that also comes with the private Discord access to my professional day trading group. So if you're interested in that, you can click the link in the description below. So let's get into what is a zero-sum game. What is a zero-sum market? Well, a game like poker is a zero-sum game. If I'm in a hand with one other person, I mean, let's pretend like there's no such thing as draws or ties, or we just negate that. My gain is your loss. Your loss is my, I mean, that's the same thing. My gain is your loss. Your loss is my gain. Your gain is my loss. If you make money in that hand, I will lose money. I'm giving you the money. And the markets are similar to poker in that sense, where it's zero sum. It's just a little bit more complex because of time frame. And what exactly do I mean by that? Well, let's first dive into spot markets, and then I'll explain what I mean by time frame. Now, in a spot market, well, let me preface by saying, what is a spot market? A spot market is a market where the actual good or commodity is being traded. So if you look at Binance, Coinbase Pro, or other exchanges that don't use margin and that don't use futures contracts or options, none of those three, what you're actually doing is you're buying actual Bitcoin that you can move to other places on the internet. You're buying actual altcoins. You can move them around. You can trade them. But futures is a bit different. If you're trading on BitMEX, if you're trading on one of those exchanges, you can't buy Bitcoin on leverage and then transfer it to another wallet because you don't actually own that Bitcoin. You own a futures contract to that Bitcoin. And it could be a short or it could be a long futures contract. Because in futures, you're betting on the future direction of an asset. In spot, it's a little bit different. So in a spot market, we only have two kinds of traders: longs who are entering and longs who are exiting. That's it. Now, let's say that you enter long and price is up 2%. You decide to sell. You are selling to a new long. And when you sell to a new long, let's say 1 hour later, what happens? Well, if the price is up 2% again, 2% more, you lost in that transaction. Because if you had held and not made that transaction, guess what? You would have had 2% more profit. You would have had a 4% total profit. Let's say instead the market went down 4% after you sold. You just saved yourself a loss, a drawdown, 4%. How? Well, because you were able to sell at a market top, and another trader actually bought at that market top. You were able to take advantage of them and take advantage of their liquidity and their willingness to buy, and profit off of that, or not lose money that you would have lost. So that's really what you're trying to do in spot markets. The goal is to try to stay ahead, and is to try to take advantage of other traders who are providing liquidity to you. Providing liquidity means that they're buying or selling or placing orders to buy or sell at bad prices. And you need to take advantage of that, because if you don't, you probably will be the one who is being taken advantage of. And you'll find that during any preset period of time, either that new long or that old long benefited. So the more complicated part of this is that after an hour, let's say price is down 4%. Guess what? We definitely benefit by selling, and that new long is definitely hurting. However, let's say 6 hours from now, the price is up 1% from our point of transaction. Then we actually lost in that transaction after those 6 hours. So you can see that it all depends on the time frame that you're analyzing. And that's why things like investing versus trading are pretty different, because with investing, it's not really as zero sum as something like day trading with a preset period of time. Now, let's go into futures, because this gets a little bit more complex than just spot trading. Now, like I had said, you are not trading an actual coin. You are not trading cryptocurrency when you're trading futures. You're making bets. You're making future evaluations of a coin, either long or short. Now, any long who enters needs to find a long who is exiting or a short who is entering. So just like in a spot market for this first part here, if you buy in a futures market, you are looking for a long who is exiting at a bad price so that you can enter at a good price in the short term. Or in the medium term even, it depends on how long you're planning to hold that trade. Or you need to find a short who is entering, because a short who is entering is going to sell. And if you are a long who wants to enter, you need to buy from someone who is selling. So what you could do is, and this is all done in exchange, so don't let this terminology confuse you, but you are writing a futures contract and you are adding open interest to the market. When a short is entering and a long is entering, and you are the long and you're entering, this is where it gets pretty zero-sum. Because when you write a futures contract, one person just entered long and one person just entered short, there is a definite, as long as those positions are open and they don't transfer their contracts to other traders, as long as those positions are open, there will be someone who is on top and there will be someone who is not on top. There will be someone who's made money and there will be someone who has lost money. That is for sure. You go to 1 hour from now, 2 hours from now, 3 hours from now, or wherever, one of those traders did make a profit. So with futures, especially in the case when open interest increases, which will happen when a short and a long enter, you are really looking to, quote unquote, write contracts with traders who are making bad decisions. That's just like in poker. You take advantage of emotional players, or you take advantage of players who don't really know as much, and you try to make money off of them. Now, yeah, basically the same that I had said here. Now, for just same thing for going short. If you want to write a futures contract to go short, well, you need to find a short who is exiting, because a short who is exiting will be buying. A short who is entering will be selling. So you need to find a short who is exiting at a bad price, maybe leaving profit on the table. They believe price will go up, but you believe price will go down. And if you're right, they left profit on the table because price continued to go down. Or you would need to actually find a long who is entering so that you could enter your short. Now, what happens to open interest? An open interest is just the number of contracts that are active on an asset, and we know that if a short enters at the same time that a short exits, that another short exits, that open interest doesn't change, because all that's happening is just a transfer of contracts from the short who is exiting to the short who is entering. But like I had said with the long case, when open interest increases and a short enters and a long enters, one of those traders is going to be doing well and is going to be happy with that profit, and the other one will not be happy. The other one is is definitely in a losing position if you're in a winning position. So really, in that sense, I would say, what is the most zero-sum nature to this whole thing? I would say options and futures are probably the most zero-sum that you can really get, especially short-term trading or day trading or scalping, futures contracts or options contracts. So let's go more into open interest, because I think that is a much better gauge of this whole zero-sum game than just talking about the basics of longs and shorts, who enter and who exit. Well, we know that open interest, you can see here. Let's focus on this point that I had made. So we know that when price is trending and open interest is increasing, that there is just as many longs as there are shorts who are writing contracts. So we know that there are just as many winning traders as there are losing traders. Because if the market's going up, let's say market goes up 1% and open interest increases by 1%, well, we know that for every long, there must be a short if open interest increased, because there are more contracts on that asset. And as price keeps going up, those shorts are going to continue losing money. And the money that they lose is going right into the hands of the longs who had bought at the time that they had shorted. Same if price goes down. If price goes down and open interest increases, guess what we see? We know that the shorts are making money at the expense of the longs who are losing money when they had written that contract with the short. Now, the interesting thing that happens is when price moves in a direction, then open interest drops, that means that there are just as many longs exiting as there are shorts exiting, which means that there are just as many taking profit as there are taking a loss. So if you see a stop loss hunt where, let's say, price goes rapidly down, goes below low, and then pops back up, and you see a drop in, let's say, 2% of open interest on a cryptocurrency futures, well, we know that for every long exiting, there has to be a short exiting, which doesn't doesn't mean that it's exactly 50-50. Not long and short will have to be 50-50. But what I'm saying is not every one of those shorts who is exiting and longs who are exiting are going to be equally. It's not like all the longs are going to be exiting in profit and all the shorts are going to be exiting in a loss. It's just that the high majority of them, of one side, will probably be exiting in a loss. The other one will probably be exiting in a gain. Especially if the market goes down, goes right below a low, and you see a drop in open interest, contracts are leaving that asset. Well, that means that those shorts are probably just taking profit. And the longs are probably having their stop losses hit or getting liquidated, or just taking the loss and just moving on. So in that sense, what's happening? What's happening to the money flow? The money is flowing out of the longs' hands into the shorts' hands, who are taking profit at the expense of those longs. Now let's go into actually in action, because I've talked a lot about theory, but in every video on theory, I always like to also go to some kind of course of action or some kind of tip or some kind of way that you can actually apply this to markets or change your way of thinking at least. So how do you take advantage of others? How do you take advantage of other traders? Well, you can grab liquidity at great prices. And this is a little example that I want you guys to read over. Imagine that you see F is at Ethereum, USD on BitMEX, is trading between 170.15 and 170.2. That means we have the best bid, the highest bid is 170.15. The best offer is at 170.2. Now, let's say that we see a ton of limit buy orders and a lot of heavy market buying. So we're pretty confident that price is going to go higher than 170.2. Let's say some retail trader attempts to reversal trade this uptrend that's clearly just going to, very high probability going to just go higher. They want a reversal trade and they place a limit sell of 50,000 contracts at 170.2. Well, what's going to happen? Well, the smarter traders are likely going to scramble to try to market buy and take and grab that liquidity at 170.2. As once the order has been placed, if everyone believes that the market's very, very likely to just move higher, then all power to the trader who can actually market buy at that limit sell order. Now, what happens, let's say 20 minutes down the road, and let's say price is up 1%. Well, that trader, that retail trader who actually limit sold at 170.2 with 50,000 contracts is now in a loss because price is up 1%. And the smart traders who grabbed the liquidity as quickly as they could are in profit. And they were actually able to profit by taking advantage of a trader who placed a very bad limit sell order. Maybe this limit sell could be, if this is a reversal trade, then it'd be a limit sell entry order. But perhaps this could be a long who's taking profit. But even if it's a long who's taking profit, it's still a limit sell order of 50,000 contracts that others can take advantage of if they're very bullish on the market and believe that price is just going to continue going higher. So that's one way that you or other traders are going to be taking advantage, which is grabbing liquidity at very good prices. Now, another example that I do want to give is I gave an example for a retail trader placing a bad limit order, or a limit order that's not really efficient because they probably could have just limit sold higher. That's why it's not efficient. There's also a case which may actually even be more common, where there are many traders who want to buy, so they place many bid orders. Now, there's a pool of traders who are interested in market selling, maybe because stop losses or just because they're all bearish. So a lot of them market sell. There's only a certain amount of those bids that can actually get filled of the liquidity of those market sells. So some traders are going to get filled and, hey, price goes up and they're happy. But then other traders are not going to get filled because there's only so much liquidity to go around. There's only so much market selling from those bad retail traders who are selling at very, very low levels because either they're forced to because of, stop loss, or they just panic, or they're trying to enter a short after the market tanks and they think it's going to keep tanking. There will be bidding. There will be traders who are placing limits to try to take advantage of those guys because then they can limit buy at a beautiful price. So think of this not just as limit orders of retail traders placing bad limit orders that can be picked off for liquidity by smarter traders using market orders. What can also happen is these retail traders or any trader can just use a gigantic market sell or gigantic market buy or even a small market buy or small market sell to fill the limit order of another trader at a very good price. All right, let's go into a very popular way that liquidity is transferred. stop hunting, and liquidations. So what is another way that traders can take advantage of other traders? Well, you can take advantage of their stop losses getting hit in liquidations. Let's go through a quick example. We know that XBT is trading at 53.85, and the smarter traders are basically leaning towards short. Whatever their analysis is, they are pretty confident that the market will be going down. Now, these traders know that there are likely many shorts, retail shorts, who have placed their stop losses just above 5,400. 5,400, it's a round number, and let's say it hasn't been reached in about 20 hours. Price hasn't gone above 5,400 in 20 hours, and price is nearing that level. We also know that there's a good chance that many traders will be liquidated right above 5,400. What do these large traders do when they want to short? Are they going to short at 53.85 and just grab the liquidity, that they can get at 53.85? Whether that's limit sell or whether that's a market sell? No, they could do something a little bit more sinister. This is what it is. They could place large bids to spoof the price higher. And once it breaches that 5,400, it's probably going to create a very long price wick. And when that happens, they could place offers, whether hidden limit sell orders or active limit sell orders that are shown, visible. They place those limit sell orders, and as all those shorts are getting, stop hunted, that's going to be a lot of market buying from the shorts. So that's going to market buy all of those limit sell orders placed by the smarter traders who are getting filled at probably the top of the market. And if that doesn't happen, then many liquidations of traders who hadn't gotten liquidated yet because of price discovery. They get liquidated, and that forces them out of their position, and then larger traders like sharks swarming the fish are able to grab the liquidity of those liquidations before the market goes much, much lower. That's basically what can happen here. Now, does this always happen super deliberately? Do they always say, all right, we're going to push price above here because we know that, there's probably a ton of liquidity, probably a ton of pretty bad traders or just traders in general who are willing to buy in mass above 5,400. Probably not deliberate. I mean, I don't know. I'm not one of these, whales or large manipulative traders, but maybe they are, maybe they aren't. But whatever is happening, once the market does go above that 5,400 and a lot of liquidity is available, many stop losses are being hunted, and smart traders or large traders are getting pretty bearish on the market, then it's going to be a scramble to grab as much liquidity from those bad traders as they can get. And then eventually that liquidity scramble is going to be over when the market actually goes lower. And then, some traders won because they actually got filled into shorts. Some traders probably did not win because they did not get their limit sell orders filled, or they did not market sell at a good price. And then there are some traders who really, really did not do well. The shorts who got liquidated when price went above 5,400, or the shorts that got stop hunted, or even the longs who market bought at like 54.15 and just played right into the hands of some smart trader who limit sold at 54.15 and is very happy that someone market bought at 54.15. All right, we've covered open interest, spot markets, futures markets. We've covered stop hunting, liquidations, and liquidity grabs. Now let's look at competition, direct competition. So when you're looking to enter long, you are competing with other buyers to get filled at as low of a price as possible. There's only so much liquidity. There are only so many people who are going to market sell at lower prices before price rises or price just stagnates. So when you're looking to enter this long, you need to play kind of like a game with these other longs who are trying to buy. And find a way to either outwit them or predict what they're doing, or try to be one of the first longs who enters, or try to be, in the early stages of longs who enter. Because the worst thing that you can do is if you have a pool of potential buyers who are trying to grab the liquidity, you don't want to be the last buyer, because then you're grabbing the liquidity, you're buying at the final seller. Not the final seller, you're buying at the highest price possible because all the liquidity has been tapped. Same with when you're going short. When you're looking to enter short, you're competing with other sellers to get your order filled at as high of a price as possible. That's what you're doing with a limit order. You want yours filled, and you don't want other traders above you to get filled, because then that would mean that they're actually selling at better prices than you are. That's not lovely. I mean, it's not terrible, but it's not great. You want to get filled as high of a price as possible compared to other people. But it also holds true for market orders too. When the price goes up to a level that many traders think is an elevated price level, and then there are many people who want to short, well, you want to be one of those faster traders or smarter traders or more reactive traders who market sell on some bids placed by bad retail traders who are trying to, maybe get their limit buy filled. And you want to take that liquidity before, price goes down. But you're competing with other people who are trying to do the same thing that you're trying to do. All right, let's say you just executed your buy. You are in a position now. These traders are now your allies because any potential buyer is on your side. Once you buy, anyone who market buys or places a limit buy order, that's going to likely, that's just going to make it more likely that price goes up, especially combination of the two. So your competitors become your allies once this actually happens. And the really interesting thing is that it's the opposite for the other side. So you're competing with longs, to buy, to go long. You're competing with other longs to get filled. But you're actually allied with shorts, with sellers, because you want your the other side of the trade to keep selling as low as possible before you enter. Those are your allies, those are your friends, not your competitors. But then this flips, because once we get filled, we need other people to buy. We need other people to buy at higher prices. We need those potential buyers to keep, buying up and higher. But we do not want the other side, the sellers, to begin to get strong. We do not want them selling. So it's really interesting how at first the side that you're on become your competitors, and the opposite side are your allies, and then that switches, because once we go long, we bought. We want other people to buy as well. We don't want other people to just keep selling, because that would hurt our profits and probably lead to a loss. Same with after we execute or sell. Other sellers become our allies because they're trying to sell as well, and they're trying to push the market lower and sell at lower prices than us, and gives us a profit. But the buyers are our enemies, our competitors, because what their goal is trying to do is to try to push the market higher. So this is kind of the, not exactly zero sum, but this is another way that you can think about the market with your competition and your allies. And one way you can screen for which side is stronger is you can look at the amount of limit buys and limit sells, so order depth. And you can look at the amount of market buys and market sells, so order depth, market order imbalances, also known as stacked imbalances. You can look at these kinds of imbalances and see which side is stronger. And if you think you found the stronger side, you try to ally with those guys by, you first compete with them to try to get filled, and then once you get filled, you ally with them because, let's say I buy, I think that the buyers are strong, and then hopefully they keep buying. So that's one thing to think about with competition and with allies, and how that flips once you are in a trade and once you are out of a trade. Now, the market isn't exactly zero sum. It's actually negative sum, and a negative sum market is when it's not that one person's win is another person's direct loss. If I win $1, you lose $1. Negative sum could be if you lose $1, I win 95 cents. That's negative sum, because there's actually money's not flowing from one person to the other. Money's flowing mostly to one person, but then the excess money is actually flowing as commission or flowing to a third party, the trading exchange or the broker. How do you beat a negative sum market? It is not impossible. It's just very, very difficult. Well, you're going to have to be able to excel in order to beat the fees and in order to beat other traders. The success rate, I do believe that the success rate for most markets is around 5% or lower, especially day traders and short-term traders who are competing with each other. Maybe the success rate for investors is a bit higher, buy and hodlers, because their competition's a little bit different, and the way that they're allied and their competitors, it's a little bit different than the amount of competition that you have on the short-term trading level. Now, why is it that 95% of traders lose? If this is a zero-sum game, shouldn't it be 50-50? Not exactly. One thing that continues to happen is traders like to take small profits and don't like taking large losses. So you're going to see just this cycle over and over and over again of traders who lose everything or lose significant amounts of money. And then new retail traders enter, and then they lose money, and then they lose money. And even if they make a small gain, that large loss that they're not willing to take gets bigger, and then it eventually crushes them. So it's not that the markets is this equal, esoteric thing where if I make $5, you are losing $5, and that's the end of the question. It's a little bit different. It could be, I make $5 and you lose $5, but then later that day, I take a bad trade and I lose, $95. And that would, for the day, I would be in a loss, but for that trade, I would be, in a gain. And there are ways in which the market's just going to continue to cycle through bad traders and retail traders who just buy and sell at very bad prices. And that's really, as sinister as it sounds, that's what we're taking advantage of. We're taking advantage of other traders who are buying and selling at very bad prices. How do you do this? Well, most important is risk management. You got to control your emotions. One way to do this is through bots. Another way to do this is through just experience and practice. Not only that, but you need to also have an edge. And one of these 3 edges that I mentioned here is probably going to do the trick. Speed edge means that you just trade faster than everyone else, like an HFT. Market share edge is completely illegal in regulated markets. It's when you hold such a significant portion of a coin or of an asset, you can just spoof or manipulate the price wherever you want. Basically having a monopoly. If you have a monopoly on silver, if you have a 50% market share in silver, you can just drive that price wherever you want and just profit off that speculation. This is pretty inattainable, unless you're talking about low cap altcoins, which, and the third is the one that I like to go for, the information edge. So if you want to beat other traders in this market, if you want to take advantage of other traders buying and selling at bad prices and want to be ahead, buy before others buy, sell before others sell, you're going to need an information edge. And that information edge can come in a gajillion different forms. But any information edge is based on one thing. Are you able to buy before others buy, and are you able to sell before others sell? And if you're not able to do that, and if you don't have indicators or strategies or tactics that will allow you to do exactly that, then you probably don't have an information edge. And that's just it. So this is going to be it for the video. I know this was a really long one, but I think that it really is interesting looking at the zero-sum/negative sum nature of this game. And if you stuck it out this long, all 28 minutes or whatever this is, then kudos to you, man. Or kudos to you, woman who made it to the end of this video and was able to do that. Yeah, I think that when you go forward in the markets, don't forget that there always is another party in this transaction. And you need to be able to take advantage of these people. You need to be able to take advantage of other traders and know who your competitors and allies are. And how do we do all of that in just one sentence? Well, you need to grab liquidity at great prices through limit orders or through market orders. With that, find your edge, define your edge, and exploit your edge. Happy trading. See you guys soon.